you who have joined. Um, Welcome to the latest in a series of webinars hosted by Pragma. Um, Today we are joined by our friends at Harvey Spack Field, and we're going to be discussing the performance and the prospects of the UK out-of-town sector as we move towards what is hopefully, touch wood, a kind of post-pandemic environment. So my name's Andrew McVicker. I'm the Director of Property at Pragma. And joining me today are Jonathan Salt, David Coombe and Sophie France from Harvey Spack Field. And we're going to be looking to share our combined expertise and knowledge and real-time insights into the sector, how the sector is performing, how performance is influencing on-the-ground decision-making, and what we see the prospects for the sector are going forward. We're scheduled to run for about 45 minutes today, and we'll be looking to include a question and answer session at the end of our discussion today. There's a Q&A box that is enabled as part of the setup, so if you do have questions, please do submit them as we go through. We'll look to answer as many of them at the end of the session as possible, and any that we don't get to, we'll be sure to come back to you directly on as well. The recording of today's session will then be made available, hosted on the Pragma website, and we'll send it round to all attendees, along with the slides that we go through today. So just to briefly introduce ourselves, Pragma are a retail consultancy, and our focus is upon understanding consumers and how you improve the consumer experience and the relevance to consumers in order to drive commercial performance and value. We work across the globe and on a range of different formats and asset types. But in the UK, our out-of-town sector work tends to be around understanding catchment dynamics and demographic profiles, assessing supply and demand, and using that information to determine occupier profitability and performance, and then using all of that information to create joined-up strategies to increase commercial value. We're joined today by Harvey Spack Field, who I'm sure many of you will already know, have a well-respected and long-standing presence in the out-of-town sector, working directly for landlords, but also for brands as well, across a range of different deals, asset types, and with numerous different skill sets and expertise that we're going to leverage and call upon today. So just a brief introduction as to where we currently stand. As I mentioned, today's session is the latest in a series that we've been hosting with Harvey Spack Field, looking at the prospects in out of town. And just to recap on those previous seminars that we've carried out, I think our focus has really been around looking at the strength of opportunity that the out of town sector provides from the basis of the consumer, the occupiers and the brands, and then for the investors as well. And just to recap, I think from a consumer perspective, there's a range of different reasons why we think out of town works and will continue to work going forward. Whether that's the accessibility and free parking, which I think should never be underestimated, the pull of that. Whether it's the more convenient trading hours, particularly trading into the evening that's better established. The outdoor environment was clearly a strength, particularly during the initial stages of the pandemic. And what we have seen is a quicker footfall recovery and greater vibrancy of the out-of-town offer that's made them a more attractive location for people to visit as we've moved through the pandemic period. For the occupiers or the brands themselves, clearly the main thing is, where is that consumer appeal? You know, where is the place, the format that I'm able to best engage with my consumer base? And so all of the reasons why the out-of-town sector works for the consumer are particularly relevant for the occupiers and the brands themselves. However, clearly augmenting that is the typically lower rates payable and significantly lower service charge versus an in-town or a shopping centre format. the standardization of units, the established concept, whereas numerous different formats are really changing performance drivers. I think the model for the out of town sector and why it works for the consumer is pretty well understood and isn't subject to the same changes and fluctuations in consumer demand as perhaps other formats are currently experiencing. What we'll touch on today, because I think it's a key point, is just how well the out of town sector format dovetails with click and collect, and we see that as being hugely important going forward. And also that ability to both service the out of town sector, but also potentially distribute from as well, makes a key opportunity. And for the investor, again, that consumer appeal and those occupier appeals are, again, real key reasons why we see investor interest in the sector. Again, that established concept and an established occupier base really helps drive sector expertise and knowledge and comfort with the sector. And again, typically versus other formats, the initial cost of both investment and the costs incurred in maintaining and driving the investment going forward are typically less than other formats. And completing that loop, I think that investor interest in the stock and the performance of the stock, again, really helps make it appeal to the consumer as a thriving and a vibrant place to choose to shop versus other formats of physical retail. Just as we move forward, I think touching on the kind of generally established trends in spend that we've seen pre, during, and I hesitate to say it, post-pandemic. You know, I was quite reticent to put a green line on the chart that we're showing here today, but we are at a period now where we've got 24 months of kind of unadulterated trading performance in what could be the new world. And pretty soon we're going to have to stop harping back to what the world looked like in 2019 pre-pandemic. So fingers crossed there are no new variants out there that are going to significantly change things. And what we are starting now to see is a bit more of an establishment of how people will spend, moving into a post-pandemic environment, albeit recognizing we're moving into one where there's considerable pressure on discretionary spend, something that we'll touch upon later. And so in the overall trends that we've seen in terms of consumer spend, clearly during the lockdown period, all merchandise categories suffered from that initial lockdown. F&B had remained, demand and spend for F&B had remained pretty consistent throughout the period. And we saw spikes in F&B and restaurants and hotels, particularly through the government sort of eat out to help out period. We saw increased spending on things like furniture and household as people invested in their homes because they couldn't go away, couldn't go out, couldn't socialize as much as previously. We've seen clothing and footwear struggle through the period and really continue to struggle. What I would say is these overall spend trends don't really provide the level of detail that really get under the skin of how different formats have performed. And it's our understanding and belief that actually underpinning a lot of these spend numbers is strong performance from the out of town sector. And that has really helped boost the physical retail performance of stores significantly. So certainly from our read of the numbers, that's what we see. And Jonathan, I don't know if that really plays to what you're seeing from your position at Harvey Spack Field.
Yeah, I mean, unquestionably, when you look at the numbers and the metrics around that, if we manage 15 million square feet and have a void rate of less than 3%, I think the market's tracking at about 6%. I think that probably tells you there's been strong performance and demand across most sectors. I do agree. The fashion and footwear is the one that is causing the most headaches as we try and fathom out where that's going and how that's best suited. But as you say, I think without the retail park formats, I think these numbers, these lines would be far further south than they appear.
Absolutely. And so I think today's webinar gives us a real good opportunity to look in a little bit more detail by merchandise category or at the performance of the out of town sector. And that's what the team from Harvey Spack Field are going to introduce to us now. So I'll hand over to you guys.
Thank you. So as Andrew's mentioned, last two webinars focused on resilience, investor perception. Let's talk about how the sectors are performing, or some of the subsectors. We don't actually have so much time, so we'll rush through what we can. Very helicopter. Ask us questions after, but taking you through now is David, who's going to talk to you about our first subsector, which is convenience.
Yeah, thank you very much, Andrew and Jonathan. Also, thank you for everyone for tuning in. I know our market is particularly busy at this moment in time, so we're very grateful for you sparing us a few moments of your time this morning. As Jonathan mentioned, we're going to take a quick whistle-stop tour through the various subsectors. The first of these is the convenience sector. What do we mean by convenience? It's the likes of Aldi, it's Lidl, B&M, Home Bargains, and the range. All of which we've just got some information on the screen there, just showing their kind of performance and trade going back to 2016 up to 2021. I don't think it'll become a huge surprise to anyone tuning in this morning when I tell you that the trading performance in this sector has been very strong and continues to be very strong. Looking back, all the operators remained open throughout COVID. This shielded the sector from any disruption we saw with the other sectors that were forced to close. Staying open really helped the convenience sector capture lots of pent-up demand, which drove up sales and ultimately has driven their profits. If we look at B&M, for example, their year end is the end of March. Profits are expected to come in around 600 to 625 million pounds, and that's ahead of the analysts' expectations of 578. And I was looking at B&M share price only this morning, and their share price since the start of the pandemic has actually gone up 57%. They joined the FTSE 100. Their share price has really put in a stellar performance. So it wasn't all bad news for the COVID for the retail sector, and in particular, it was very positive for the convenience guys. We look at the range as well. They're another benefactor from staying open during COVID. They've recently posted profits of 145 million pounds, and that was up 47 million pound last year. If we have a look at the German supermarkets, Aldi and Lidl, they both continue their growth trajectory. That shows no sign of abating. Aldi now have a market share of about 8% of the UK grocery market, and Lidl is about 6.2%. Both continue to grow their market share, and both are nibbling away at the big four. Interestingly, if we look at the online division that the convenience retailers have, it's actually very limited. They do have websites, but not all are transactional. I think that's largely because the infrastructure that you need to facilitate online ordering, home delivery, returns, it doesn't really sit well with the low price points and the average basket of the typical retailers. Therefore, how do they grow their businesses? They need more stores. They want more stores, and we've seen this in the markets. And I think any agent tuning in this morning, no doubt would have done the lion's share of their lettings in the last 12 months to a B&M, to an Aldi, to a Lidl. So, their appetite for more store continues. We've seen both Aldi and Lidl wanting another 50 stores each in 2022. The likes of Food Warehouse, they want another 20. Home Bargains want more stores. The range, again, which we've touched on, they want another 10 to 15 stores. And I think they'll continue to roll out the Iceland concession within those stores, which has been a big success. So from a landlord perspective, that's great news. We know securing a letting from one of these discount operators is extremely desirable. The covenants on offer are first class. They offer long leases, and they also drive footfall on retail parks to the benefit of other tenants. We've also seen extremely strong investor appetite for parks anchored by an Aldi, a B&M, or a Home Bargains. It's very much these kind of schemes which we're seeing the sharpest yield compression as the weight of equity in the market chases what is quite limited stock. So we expect the sector to continue to perform well. I think one of its challenges perhaps could be whether their expansion plans and growth targets can be met, especially given the vacancy rates which we touched on earlier. We've seen research recently saying that the vacancy rate in our markets is hovering around 6%, but as Jonathan alluded to, we've done an in-house exercise, and void rates across 15 million square feet that we manage is about 3%. So, as an agent sat here, I'd dearly love to have a plethora of 20,000 square foot units that I could let to these guys, but unfortunately I don't, because I've already let it to them. So, convenience, I think in summary, continues to perform well, and, it's played a really large part in the success of our markets in the last few years. So that's all from convenience. I'm now going to hand back to you, Jonathan. You're going to have a chat through the DIY and the bulky goods sectors.
Thanks, David. I mean, I don't think we can underscore the investment value of the retailers in that convenience sector, David. We've seen yields tumble, haven't we, for Aldi, etc. Amazing, really.
We have. They are, they're very much the darling of the sector, aren't they? And very sought after covenants and leases, quite rightly.
Yeah. Well, I mean, I suppose, turning to DIY, the pandemic, I mean, the bulky goods sector is a wide sector. I'm going to touch on DIY furniture, beds, soft furnishings, floor coverings, and bikes, or call it Halfords. But effectively, looking at the bulky goods sector, it's seen a decent resurgence post-Brexit. The pandemic for DIY retailing was fantastic. The staycation, the staying at home. I think we've all stayed at home more time in our lives, working lives, than any time. And as a consequence of that, has spent money, as Andrew pointed out at the beginning. You look at the DIY spend on the slide. Don't be misled by Homebase. Those store numbers, they now operate from only 154 stores, and the turnover is right up there. We're seeing B&Q, all the three major players having sales growth and maintaining margin as a consequence of demand being there. And as a consequence of that, they want more stores. B&Q this week, more focused on the town centre format, smaller formats, complement their large estate. Homebase still looking for lots of traditional 25,000 square foot stores with 10,000 square foot garden centres in many, many locations. We closed 100 during the CVA, so there's a hell of a lot of gaps that need to be filled. We're currently acquiring 6 stores a year. Subject to the deals, we'd take more. Wix yesterday confirmed that they want 30 new stores. Whether or not that's per year, I don't know, but it shows the positive intent from within the DIY sector. Moving into the furniture sector, we have to just take stock that the pandemic with their supply chains was a real problem for this sector, with so much furniture being made in China and across Europe. Joining up those supply chains during the pandemic caused huge problems for a lot of them. So let's be clear, without the government support and landlords being of assistance, they would have been in trouble. But following the pandemic, there's been pent-up demand. They traded extremely well. There are requirements out there from those without mature portfolios. We recently, Harvey Spack acting for DE, just taken a store at Brent Cross, which I would advise all the landlords to go and have a look at. It's amazing. It looks incredible, and we think it's the future. And so Tom Wyatt, my colleague, will probably be in touch with you to see if there are any deals out there with landlords. We're looking to put them on the best furniture parks. Also seeing, the decline of Harvey's has massively helped that sector. When they went into administration, their annual sales were circa 350 million. And as a consequence of them going, 2 great things have happened. Those sales have been spread around the existing players. And on top of that, it's allowed Benson's to escape the clutches of its parent and actually grow on its own in what we knew was a very good business. We know Dreams is also a very good business, and so we can say that the bed market is a strong market. You know, unlike the DIY market, we see acquisitions in the bed and the furniture market to be much more targeted. We're dealing with mature portfolios, so a lot of it's probably going to be about estate management and looking after the existing estate. Again, looking at the homewares market, really monopolised by Dunelm to much extent. Barker and Stonehouse are there, but we see them moving to a sort of freehold model. Dunelm, we don't see many acquisitions, but we see good trading performance, and we see portfolio management as something that they're going to focus on. Finally, we should probably talk about the carpet market, given the Harvey Spack Field Act for Tappy. In that respect, a very difficult time during the pandemic. You know, the type of businesses that they operate and their inability to open during the enforced closures, unlike DIY, made life extremely difficult. Only again with the understanding of the supplier base and the landlords, together with government assistance, were they able to make a success of reopening. What we can tell you is that Tappy continue to take space across the UK. Their market share continues to grow. And for those that have been in, I think you'll realise that that's a modern carpet shop and is now a real competitor to the market leader Carpetright, who have recovered since their prolonged CVA. We just hope that the current situation allows the affluence of these retailers to continue and provide the customer with real choice. And that's the end of the DIY and home market, and I'm going to send you back to David, who's going to talk to you about the gym sector.
Yeah, thanks, Jonathan. Yeah, back over to me, and we're going to have a quick look at the gym sector. And I think it's fair to say that the gym market it's really had some dramatic changes in the past 10 years. The market used to be dominated by the likes of Fitness First and Virgin Active. They were very much catered towards the middle market, and while there were more expensive options in the form of David Lloyd, for example, the options at the lower end were typically limited to the independent and locally run gyms. However, over the last decade, as we can see on this slide, there's been emergence of two brands in particular that have looked to change that. Pure Gym and The Gym began a pretty aggressive acquisition program some 10 years or so ago. Pure Gym now have circa 300 gyms, and The Gym have about 200 gyms across the country. So what have they done different? What have they brought to the market which wasn't there previously? They both operate a 24/7 model. They have a very simple membership structure and membership pricing, which is very competitively priced, typically between £15 and £25 per month. That's roughly half of what your membership at Fitness First or Virgin Active would have cost you. And the term discount gym is used a lot, but I think anyone who's actually been into one will agree that it's not discount at all. I was on site yesterday and went into one of the gyms, and it's a fantastic environment. So the range of equipment is first class. That's top of the line machines, cardiovascular machines, fixed resistance, free weights, and all your classes are included in the £15 to £25 a month membership fee as well. So you get a lot of bang for your buck being a member of one of these so-called kind of low-cost gyms. There are other brands that have entered the market. We've seen JD Gyms come in, as well as some franchise-led operations such as Snap Fitness and Energy. But sticking with the market leaders, just for the time being, their appetite to grow remains very strong. At the end of last year, we saw KKR make a £300 million investment into Pure Gym to help drive the growth of their business. Speaking with their acquisition guys, I know they're looking to add another 40 stores a year and eventually double their portfolio from 300 up to 600 gyms. The Gym, similarly, aggressive plans. Speaking with their guys, they're on the hunt for more stores. Some of the acquisition guys were in seeing colleagues of mine earlier, and I've got a very interesting landlord pack which I was looking through, and I picked out quite an interesting piece from PwC, They've done a bit of research looking at what the UK market could sustain, and they think that over the next 5 years there's probably capacity for about 1,200 to 1,400 low-cost gyms. It's currently 700 in the UK, so you can see there's plenty of room for this market to grow even further. As an agent, thinking about, I did my first letting to a gym back in 2015 in Reading, I think it was. I think there was definitely sentiment then that if you did a gym deal, it meant that you probably didn't have any retailer demand. I think that's completely changed. I don't think that holds true. I think the merits of doing a gym letting now are extremely well known. The covenants that both Pure Gym and The Gym offer, they're 5A1, they're first class, there's long leases in place, and they pay market rents. Again, I think they provide a point of difference to a retail park. They bring footfall to schemes at different times, and we've seen they really help the kind of food and beverage offer on the parks as well. And I don't think there's anything quite like rewarding yourself after a tough workout in the gym with a McDonald's or a Greggs on your way back to the car. But it's not all been plain sailing for the gym operators. They were among the hardest hits during the pandemic. They were forced to close for 6 months or so. But what we have seen is that they've bounced back really strongly. We've seen a population that keen to get back in the gym. And this is a trend we think is really going to continue. I think as personal well-being becomes an ever important feature in our lives, whether that's eating more healthily, drinking less. I think being a member of a gym is an important part of that lifestyle. I know The Gym, again, said in a recent publication that 20% of new members have never been to a gym. So again, we're seeing this trend towards a more healthy and more active population. And I think to support that, I was looking at some research as well, looking at gym memberships across Europe. It typically sits at around 20% of a population. Countries like Germany, it's more like 25%, whereas in the UK, we're tracking at about 15% at the moment. So if you think the population of the UK is about 65 million, that suggests there's potential another 3 million gym members out there in the UK. So it's no wonder that these guys are looking to grow their businesses. They see there's a bigger market share to be had, as we need to be healthier and improve our lifestyles. So, very much a sector on the up, very much a sector which is continuing to perform well, and I think is being very welcomed by investors, given the quality of covenants and the leases that they offer. So a good news story. That's enough on the gyms. I'm going to hand over now to Sophie. She's going to have a chat with you on the A3 sector with a particular focus, I think, on the drive-thrus.
Yes, thanks, David. So we're going to do a complete 180 from talking about health and fitness with the gyms and dive into the drive-through market. But it is also worth noting that due to the continued surge in footfall we've seen, particularly over the last 12 months onto retail parks, we're beginning to see new entrants such as loungers exploring inline opportunities on schemes, as well as the likes of Wagamamas, who are also inquisitive, subject to the rights lineup. And of course, Nando's and Domino's, who we do a bit of work for, still remain very active throughout the out-of-town retail market. Now, it won't come as a surprise for many of you when I say that demand for the drive-through opportunities has significantly increased due to COVID-19. Towards the end of the first lockdown in 2020, drive-throughs enabled the public to eat out. So the UK population welcomed an excuse to finally get out of their houses, even if it was just to eat from the comfort of their own car. However, this had a significant increase in consumer spending on drive-throughs, which increased by 45% between September to November 2020. This, of course, had a very positive impact, and we saw demand for drive-through accommodation increase by 25% in 2021. And as you can see currently on the slide, projected demand for the fast food market is just increasing year on year. Also, the market has also got more competitive. In recent years, we've seen several new names enter the UK drive-through market. Tim Hortons, Popeyes, GDK, and Wendy's are just to name a few. They're all have aggressive acquisition plans, and This is an attempt to detain the growth of household names such as McDonald's, Burger King, KFC, and Starbucks. In October 2020, Tim Hortons announced their plans to open a drive-through market in every major town and city within 2 years, whereas Popeyes have announced their plans to open 350 stores across the UK over the next 10 years. So both have extremely aggressive acquisition plans. So it'll be interesting to see how those two do over the next few years. We're also seeing food and beverage names that are typically found on high streets begin to explore this drive-through world. In June 2021, Leon announced they were opening their first drive-through market in West Yorkshire, and in August 2021, Five Guys opened their first drive-through on Middlesbrough's Teesside Retail Park, and both are exploring further opportunities. Unsurprisingly, this very competitive environment between the drive-through occupiers is creating some very attractive deals for landlords. In attempts to successfully acquire the sites, we are seeing rents are being driven up, lease terms are being extended, and the incentives are being reduced. This means that we're seeing 15-year leases as a minimum. There's appetite from the operators to safeguard their leasehold operations with longer leases, which will generate further value. Whilst the market is moving so quickly, some operators are keen to cap their rental exposure with review clauses to RPI. This is suggesting that it will provide some control on rents via a cap and collar review. However, some entrepreneurial investors may prefer to see rent reviews to open market value. It's also worth noting that longer leases are also becoming a requirement. As many of you will be aware, costs to build these pods have risen substantially, with drive-through units costing about £250 per square foot. So whilst competition is a primary reason for this rental growth, we cannot ignore the costs of developing these state-of-the-art pods. We at Harvey Spackfield have not seen any let up in demand. As you'll see, the bottom graph shows that there is still plenty of spaces to go after drive-throughs. We manage retail parks right across the UK and have drive-through demand on most, if not all. The issue is whether the land is available to accommodate such opportunities, which is going to be one of the greatest challenges to this sector. I'm now going to pass you on to John, who's going to discuss all things fashion.
Hi, thanks, Sophie. Wanted to, made me really hungry, actually. I wanted to sort of talk about fashion because I think it's one of those areas of topics which no one really wants to talk about, because no one really, wants to really understand, maybe for financial reasons, where it's going. And so I think there's a little bit of head in the sand stuff going on. But I think those that really do understand what we're seeing out there, I think we'll see that retail park formats are the ideal format for the future of mid-market fashion retailers. The reason I say that is because we believe that clicks and bricks are the absolute future for retail success in the fashion market. We look at ASOS and we see that the pandemic was amazing for them. They actually did 3.6 billion of sales during the pandemic. I think 7 billion in total, if you take the whole period. And they made a gross number of something like 300 million, which is less than 5%. And I think when you just look at that and you look at the fragile nature of that business and you understand your own purchases and how you buy your fashion goods, especially online, you'll buy them, you'll try them on, you'll put them in a bag and you'll send them back. There is a cost to all those actions. And unquestionably, that must affect margin in a huge way. So we believe that retail parks are omnipotent, in respect of mid-market fashion. And as Andrew pointed out at the beginning here, these stores act as a distribution location as well as a retail outlet. and are ideal for retailers to operate from. Let's look at Next. I mean, I would talk you through all the acquisitions that have been going on in the fashion market, but there haven't really been that many. The only acquisitions that we've really seen are from the fashion leisure market, and I'm going to talk about those in a minute, but I just wanted to dwell, if I may, on Next, who are unquestionably the largest, most successful mid-market fashion retailer in the country, and certainly the leading light on retail parks. We understand from them that they expect the channel shift to continue, and this will also put pressure on their store portfolio. You know, in order to get over those hurdles, we see Next, like all their peers, needing to guide the consumer to a clicks and bricks model to avoid the financial pressures of the pure online. And really, you know, not giving the consumer the choice, we think will be their saving grace. And we think if they do give the consumer the choice, the cost of delivery and dealing with returns will inevitably lead to retail failures. You know, 50% of Next online sales are collected through the stores, and 85% of the returns are given back through the stores. And so you can see the reasons why they are successful. They're driving their customers into their stores, probably purchasing more goods as they do it, but also saving on all those distribution costs, whether it's a good purchase or a bad one. And so whilst we see Next wanting to consolidate their store portfolio, we don't think they'll be able to do it in the out-of-town market. We think they need them because of how they act as a distribution point, click and collect, and a retail operation. As David said, you know, landlords shouldn't really fear. There's a lot of demand out there from excellent covenants in the convenience market and also the furniture market. And so if the fashion operators are unable to work it out themselves and pretend that they don't need retail park stores, then I think landlords will just turn on them and they'll let them to more stable convenience type retailers who are less cash hungry and take longer leases.
Thanks, Jonathan. So I think that gives us...
Sorry, someone was calling me, can you believe? So that's what that was. I do apologise, Andrew. I haven't finished, so don't stop me now.
No.
So from that, thank you for cutting in though. It'll be interesting. So I just want to talk about Primark a little bit if I can, and then I want to talk about the leisure market and the leisure fashion market. We're not quite sure what Primark will do, but given what I've said about click and collect and the fashion market, I'll be amazed if Primark don't actually dip their toe in further into the market. You know, H&M, who've been a difficult operator to deal with, I suspect will become less difficult as they embrace the click and collect model. And hopefully they won't close stores that they've been threatening to do, as they see the absolute need for that clicks and bricks. Turning to the real success stories during the pandemic, which continue to carry on and show no sign of abating, you know, the leisure sportswear market. JD Sports saw exponential growth during the pandemic, posting EBITDA of circa 730 million. And we can see that with the lack of formal fashion, with people working from home, with people taking up new exercise, I should say, new sport, etc., etc. You know, the leisure wear market is now part and parcel of everyone's wardrobe. Okay, so we see that as moving forward. Fraser's doing an amazing job with their brands, and the customer journey they've got in their stores is brilliant. We know that Next are going to take some department stores because they can't afford not to, with the deals that the landlords of those that are offering them will give them. But the reality of it is, you know, given the way the fashion market is evolving, you know, it is an online business, but it doesn't work. Retailers can't make the money with pure online. And so it is our firm belief that the retail parks are a major part of any fashion, mid-market fashion retailer success story. The question is, how do you translate that into income, and how do you get to the end game? And Andrew, I'm done.
Thank you. Just a note that we're running close to our sort of 45 minutes. I think we've probably got another 10 minutes or so that we'd like to keep people on, particularly to answer some of the questions that have been posed as part of the session. Just as we move from looking at those subsectors, we did want to highlight, absolutely aware of the headwinds that the sector is facing, as all sectors are facing over the coming weeks and months. Certainly in terms of inflation is grabbing the headlines at the moment. And not only has it been rising significantly, I think from most analysts reading, that growth is not going to be stopping anytime soon. And that certainly presents a challenge to all retail, no matter what the format. In terms of some of the big pressures that we've seen, things like heating costs, electricity and gas, the average household is going to be expecting around a 54% increase in their annual heating and lighting bill. And I think 18 million households who were typically paying about £1,300 last year are projected to be paying in advance of £2,000 this year. So there's a significant increase in those costs and therefore pressure on discretionary spend. Fuel on the rise to some all-time highs. £84 is now the cost to fill a standard car, and slightly higher for diesel. And I think, the horrific scenes that we're seeing from the Ukraine and sanctions against Russia are only going to result in increased costs on fuel going forward. I think also, unfortunately, what it does is potentially limit the immediate switch to solutions such as electric powered vehicles, things like palladium, which are a huge component in car batteries, principally served from the Russian market. And so it's difficult to see access to those sorts of materials, again, not seeing increased costs going forward. What we're also seeing is significant inflation on food prices as well. I think that creates both pressures and potentially opportunities for the out-of-town sector going forward, particularly given the strength that we've seen in terms of provision and performance of the likes of Aldi and Lidl. So as well as seeing pressure on consumers in terms of their spend, we're also going to be seeing pressure washing through to the occupiers and the brands. And some of those will include the increase in national insurance. So we'll be seeing this spring an increase in 1.25 percentage points in national insurance contributions. Also a rise in minimum wage going forward. So that's going up 6.6% from £8.91 to £9.50. And so this again just brings through the pressure that occupiers and brands will be under in terms of driving their performance and also being able to sustain their occupancy costs. Now, as I mentioned earlier, a lot of what Pragma do is understand catchment supply and demand, but also try and shed some light on what is still, unfortunately, quite an opaque relationship between landlords and brands, and what their actual performance is, and how the two can then work together to the benefit of both. If we were to look at just a standard sort of model for an out-of-town occupier and work through some of those increased costs, something like a £60,000 rise in operating cost, which you could absolutely see coming forward in terms of increases in heating and lighting and in wage and contribution costs, that requires around a 5% increase in sales performance in order to be able to sustain the same level of profitability and therefore occupancy costs going forward. Now, 5% in the current market would be strong performance, but certainly not unachievable. But I think where we see particular pressure is on gross margins. I think looking at the JD accounts earlier this week, you're seeing the amount of hedging that's need to be done in terms of buying containers and support sourcing supply to each of the occupiers. And any of this sort of pressure that affects gross margin has a huge impact on lower profitability at a store level. So something like a reduction in margin from, say, 51% down to 45% starts to see the need for around a 17% increase in sales performance at unit level to again create the same sort of branch contribution before head office costs that would have been achieved previously. And so I think we are increasingly going to be operating in an environment where occupiers are increasingly challenged in terms of their costs. And I think landlords need to be aware of performance and the ability of occupiers to sustain the costs that are being requested, and really truly try and create that joined up relationship that benefits both of them. Because we do see opportunities going forward for the out of town sector. And I think it's really a case then of saying, how can we recognise and build on these opportunities going forward?
Andrew, could we just answer some of the questions that have come through?
Yeah, absolutely. Yeah.
Okay.
If you'd like to tackle straight off, John, please do.
Yeah. So I'm just looking. We've got one from Mozgan in terms of fuel price, out of town shopping prices, and what's the impact of that? Look, I think the impact of full fuel prices is going to impact on everything. It's not just going to impact on retail parks. Yeah, sure, people have to get in their cars to do that, but we're such a car-borne society. I suspect unless it gets absolutely horrific, not much will change in the short term. The question about uncertainty from Daniel Owens, I think that's really a consumer uncertainty question, I suspect. I think we're all aware we don't really buy much or consume much from Russia. Clearly, what's going on is terribly distressing, but I'm not sure that supply chains, aside from the food and fuel market, are going to be that affected. Yeah. And again, we've seen yesterday, haven't we? You know, the Saudis providing more oil to help the supply. So I think you know, globalization will see us through those things.
Yeah, I think Jonathan as well. Just finishing on that point, I think, you know, Daniel, you make a very good point. It does feel very uncertain at the moment, and it is very concerning what's going on in the Ukraine. But if you look back, you know, we haven't really had a period of stability really in the UK for the past 5 years or so. It used to be everyone would talk about Brexit, which is probably once in a generation thing. We then rolled into COVID, which, you know, was probably once in a lifetime thing. And now we've got this awful war in the Ukraine. But if we look back over the period of 5 years, you know, we've seen the resilience of how the operators in the retail market have traded. They continue to grow. You know, it is a format that has proved itself, and I think will continue to do so.
Yes, I completely agree with you, David. The one thing we really haven't touched on here is that the government are considering an online tax. You know, what happens to ASOS if that comes in? I mean, they've got tiny margins anyway. So I suspect, you know, it's all about multi-channel. You know, we've obviously got the bulky goods and the discounters that can't trade online. But, you know, essentially, these retail parks are a fantastic forum for retailers to do multitask. Yeah, it was a very interesting post by Tim Valance. You know, and he talked a couple of weeks ago. I thought it was a great post on LinkedIn. And it was a rhetorical question about what's more valuable, distribution units or units that you can distribute and retail from, which have dual purpose. And we see that market, you know, being chased by all sorts of investors. So I suspect there's more room to go in the retail market.
Yeah, and final question from Matt Wilden. Nice to have one of our very important clients tuning in. When do you think we will see some rental growth return into the out-of-town market? I think that's a very topical question, which we talk about a lot in our kind of Monday meetings. You know, I think I think soon is the answer to that, Matthew, but only in certain locations. You know, there are certain towns which we've talked about where there is too much space, there is too many voids, and you know, you simply won't get the rental growth coming through in those markets. But where the supply is squeezed and where the demand is good, you know, that's where we're going to see it.
I mean, it's that sweet spot, isn't it, Dave? It's that sweet spot of what size a retail park allows you, and it's size, town, it's all those metrics, you know, and an investor needs to understand that. I mean, I think the fact that we're trading at 3% of void rate, David, if we want to do any agency transactions, we're going to have to get rental growth. Otherwise, our clients aren't going to do any deals. So
absolutely. You know,
so at some point, I suspect you're right.
I think where that also comes in is as you say, it's picking, understanding location, understanding customer and supply and demand. But I think as a general view, the town centre market has never been weaker in terms of its proposition. And frankly, despite a lot of talk in the industry about all the positive changes that are being rolled through, I'm yet to see much that is truly tackling the key issue of the relevance of town centres to the consumer. And therefore, I'd say the opportunity for out of town in the right location with a right understanding of what the consumer wants. I think the opportunity has never been stronger for the format. And therefore, that surely should offer some opportunities if the town centre market in particular continues to weaken going forward.
Absolutely. I mean, look,
I also think that some schemes will need to be rebased prior to us seeing any of that rental growth, which is something that a lot of landlords will have to factor in.
Most of those are the fashion schemes, aren't they, Sophie? Yeah, and I suspect, you know, on that, you know, there's a lot of panic, but I really believe that those fashion retailers, and you're right, they do need to be rebased, but I genuinely believe that, you know, if Next start closing their out of town shops, they're going to do themselves ultimate damage, right? You know, click and collect, clicks and bricks is the format to make money. Yeah, they can do turnover online and they can do turnover in shops, but it's that combining them both in convenient, accessible, free car parking locations that are going to be their bread and butter. I'm convinced.
We're seeing a lot of rise of the direct to consumer from the brands, and as you say, Jonathan, if the occupiers begin just focusing on online only, then it's such a crowded marketplace that it's difficult to make money in, and it's difficult to show that real point of difference. So I think the stores absolutely offer.
Yeah, but you know what, Andrew, and I know we're probably going to go over here, but it's okay to talk about it. But you know what's really interesting is you read JD and they're supplying other people's goods, you know, bringing other brands in, you know, they do all of that. You know, Sports Direct have their own brands, and so these stores are Next, you know, are selling everyone else's stuff now, right? You know, even ASOS are doing that now, you know, or trying to grow that. And the reality of it is, you know, I can see these shops potentially getting a little bit bigger as they house more brands, and we end up with sort of a mix between Sports Direct and Fraser's, and, you know, the Next department stores, for example, the bigger stores, they're going to be the ones that are going to be the most benefit to them, because they'll be able to carry all the stock, and they will be a dual purpose store.
Fantastic. So I'm wary of time, and I think we've managed to get through a huge amount of content there, but hopefully answer those questions as well. So I'd like to thank the panel, the team from Harvey Spack Field for all of those insights there. Also like to thank all of the attendees. As I say, we'll make the recording and the notes available and be looking to host future webinars in the coming months going forward.
Andrew, can we just quickly go back to Carolyn Sparshot, who was talking about rates? I don't think the government's going to change the rates. I mean, there shouldn't be any rates on any retail parks because no services are provided. But if you take that money away, the only way the government's going to get that replaced is if they do an online tax. So, you know, that's how I see that planning. I can't see the government giving rates out. I can't see them losing that income. in the short term. Sorry, Andrew.
No problem at all. Thanks for answering that one, John. And say, if people have further questions, please do feel free to contact any of the team here that have been on the call today. Thanks everyone for your attendance. Much appreciated.